Hi, everybody. This is Lance from datatraders.com, and today we have part two of an interview with David Jaffee from stockstrategy.com. How are you doing, David?
Good, good. I'm glad to be back, and it's great to speak with you again.
Yeah, great for part two. I know in our part one video, we had a lot of comments on our channels saying we should do this again, and if you could elaborate more on these different strategies. So it's great to talk to you another time here. I know one of the main ones that a lot of people are first wondering is what's going to happen with the market in the near term and maybe medium term. And that's definitely one that a lot of people are usually curious about. They think that we're the gurus that are going to know exactly what's going to happen to the exact SPX price. But obviously, we're just going to give our opinions here. What are your general thoughts in near to medium term, maybe up to the election this year? What do you think is going to happen with just the general S&P 500?
Yeah, so I know that anything I say is going to be wrong because if I could predict short-term movements, and I probably, or if I could predict short-term events, I'd be buying lottery tickets. But I definitely think that having the market go up around 30% over the past 18 months is something that doesn't happen that often. So the market seems a little bit frothy. Additionally, when you have volatility be as low as it has been for the entire year, it's basically been, I know that I think it spiked up above 20 in like April when there was talk about like Iran striking back against Israel. But for the most part, VIX has been, or maybe at that time it spiked up to around 18 or so. But for the most part, VIX has been trading below 15, and oftentimes it's been below 13, which is extremely rare to have it that low for extended periods of time. So I think that um, it's not unlikely that we'll see some increased volatility starting around September, which is usually when volatility increases, like after the summer vacation and after people come back. Heading into Q4, you start seeing increased movement in the market, and then there'll probably be some increased volatility as well around the election. And then depending upon how things go or any geopolitical events, I definitely expect there to be, at least a minor pullback. There really hasn't been much of a pullback this entire year, perhaps like a small 8 to 10% pullback, but that was basically erased over within like the next week or so, like subsequent to that pullback. What are your thoughts?
Yeah, I agree. I was looking at the future volatility for VXX actually today, and yeah, we're near historic lows in the high 12s right now. When you're going into the election, October, November, it's predicting around 18 to 19 for the VIX at this point. Obviously, with geopolitical events, or if the election ends up being challenged, or a lot more uncertainty about who's going to be the next president or current president. Obviously, the volatility could increase. That should be good for option sellers in general because you have more volatility, you could get more premium out of different positions. In terms of S&P 500, yeah, we're well, again all-time highs pretty much. Besides the last few days of slight downturns, there's a good chance that we might see a slight pullback. RSI daily is pretty much all overbought, but it's been like that for months. If you look at Bollinger Bands, we're near the upper bands as well. So there's a good chance that it could easily drop down. If you look at a lot of the volume for volume profiles for SPX in the last few months, we still have a large amount of volume, about 150, 200 points below the current SPX. So that's a possibility that we could get back to that range. It could still reach new all-time highs for all we know. It's going to be very interesting to see what might happen in terms of volatility increasing and S&P 500 and whatnot going up.
What are your thoughts regarding buying some long-dated VIX calls? Is that something that you've ever looked into?
Yeah, I've considered it. With the VIX right now, we're still in contango from the futures, which is pretty common. About 80% of the time, it's like that. So it's a little hard to actually buy the VIX calls. It's fine as a
Right.
hedge against your positions,
Right.
especially if you're mostly long in the market and then we see a downturn, your VIX calls could easily increase. So as a hedge, I think it's perfectly fine. I'm actually looking into another strategy of buying put debit spreads on the VXX. As long as we're in contango, has a pretty good win rate and pretty accurate, especially in contango events. But obviously, if you hit backwardation and the VIX flips, then I probably wouldn't do that strategy at all.
Understood. And have you made any changes based upon, since both of us believe that there will be a pullback or some increased volatility around like the election time, have you made any changes in your portfolio for that time or not yet?
Yeah. Yeah, so I'm primarily futures options. So I sell a lot of futures. We'll talk about the 112 trades shortly. I'm pretty low on my low on the buying power that I'm using. So I have a lot extra buying power available because of the low VIX. Especially if the VIX increases, your span margin requirements will increase, could be pretty dramatically. Also, I will be going on a cruise in about 3 weeks, and we're purposely not using internet. So if we have a crazy black swan event during that, it's going to be a little bit of trouble, but I'm also going to be hedging appropriately for that. So yeah, I'm staying relatively low. Typically, I want to use up to 50% of my buying power in more quote unquote normal VIX conditions and like the mid to upper teens. Right now, I'm pretty low. I'm about 30% of my buying power. Have you changed anything based on your market conditions?
I think I think I overhedged, and the hedges have kind of acted as an anchor, and I'm still doing well in the overall account. However, when you hedge and the market continuously hits all-time highs and then volatility continues to trade, between like the 12 and 14 range, then those hedges end up showing you a little bit of a loss. So I'm already hedged for the downturn. But I think that the biggest change that I'm making is any of my short put positions or any of my positions that I think have a higher beta relative to where the market is that have an expiration of August. I'm trying to close those out early, and then I'm not going to put those positions on in September and October. So I think that similar to what you said regarding not having a lot of or not using a lot of buying power, I think that for me, I'm trying to take positions off in July and August, and then I'm simply going to trade lighter and sit on my hands. And it's okay for me to to free up an incremental 20 to 25% buying power and then simply wait for the increase in volatility.
Yeah, makes a lot of sense. I know, and probably very similar to you, we go for anywhere between 2.5 to around 3.5% a month on our overall accounts. I've been talking to quite a few people that might be interested in one of my services, and they want to get their 20 to 30% a month, and it's not.
Yeah, go follow someone else.
Yeah, follow the mean people.
Yeah, it's
So
just
with
not
those,
it's not realistic,
exactly. With those conditions, especially with SPX, what is it, up around 15, 16% for the year to date?
Yeah.
That's looking at 2.5, 3% a month anyway, if you just buy and hold SPY. And I'm pretty close to in line with it. I think I'm within 1% or two of that. So I'm perfectly fine with that because that's what my overall goal is to make 2.5% a month. So when the VIX is in a raging bull market, it's going to be really hard to beat it out, quote unquote. However, there's a good chance that SPY could easily at least stay neutral or possibly slight downturn or even a slight upturn from here. But if you have the right strategies in place with the appropriate hedges, then you can consistently get that 2.5, 3.5% a month. Well, in the long term, you will, most likely beat out the SPY and whatnot.
I think an amazing strategy is to keep pace with the market when it's in a roaring bull market, but then dramatically outperform during large scale pullbacks and black swan events or even grind down markets. That's the type of strategy that's really the strategy that is the easiest to implement. And it's also the strategy that, in my opinion, long term substantially outperforms and provides higher and highest risk adjusted returns.
Right. I think that's a good segue into the 112.
Exactly. I was just thinking that.
It's a pretty good strategy in those exact same conditions that you said in a really strong bull market. Now, I'm primarily 112s. I'm about 70% of my account, and I'm staying in line with S&P 500 during this big up moves. But having these initial, in the 1-1 side, you have the put debit spreads in place. And then what I do is you have the put debit spreads, you have your two naked puts that are well below it. And then when we take off those naked puts, I keep those put debit spreads on in my account. And that acts as a mini hedge against the whole portfolio as well. So I'm in very good shape if the market happens to drop about 5 to 10% or so in the next few months. I'm not going to be losing 5 or 10% in my account because I have these hedges from, up to 60 days from now. We already have hedges that already closed out.
And you primarily put on the 112 with trading futures on the ES, is that correct?
Yeah, correct. So I do this as a campaign trade where every 2 weeks I'm going to be adding in a 112 on ES. And I typically are really far out in time, typically 120 days. With the VIX being low, I'm even looking
Right.
at, and I did a few 180 days out. So
Right.
we're looking literally half a year out on these trades. And what's good about the campaign is when you start the trade at say 120 days and you sell two naked puts at around a 0.05 delta, the average time it takes to get 90% of the premium decay is about 93 days out of the 120. With this big bull market, we've been closing them out earlier than that because as the market goes up and you're already selling really far out of the money puts, those are going to be able to hit their target profit even faster. So we've been averaging about 65 to 70 days on some of the more recent ones. Now, with that, we have an extra about 30 to 50 days with the put debit spread. So that put debit spread is still in place. We're already happy with the
pre-hedged.
Exactly. We're already happy with the target profit by selling those naked puts. And we factor into the account the cost of that put debit spread into our results. And then you just leave those put debit spreads on. So I have about 4, I think, currently put debit spreads that are already taking the profit on the naked puts. I'm just leaving those put debit spreads on. So that if the market happens to drop, we have those extra hedges in place.
I think that's incredible. And one of the primary reasons why is that when volatility has a tendency to spike up, it spikes up very, very rapidly, especially when the market is up around 30 to 35%. It would really be nothing for there to be a 10 to 15% pullback. And because we're in a roaring bull market, you can then close out those short 2 ES contracts, as you have been doing, significantly faster than you have been earlier. If it was projected to close it out at like 92 and you're closing it out at like 56 to 62 days or whatever, whatever the math works out. And then you have the incremental 30, 35 days where the market can simply pull back at 10, by 10%, and you can then layer it on you have that protection for September. You have that protection for October, November, December.
Exactly.
There will come a time when the market will pull back. And because that position, that hedge has essentially been free, you can profit tremendously from that position. I think that's a great structure.
Yeah. So for an ES112, you just look at some of the sample numbers. It typically takes about $6,000 to $7,000 in initial buying power. And this is off TC Trade, by the way. They'll have different margin requirements on the different brokerages you use. So about $6,000 to $7,000 for a 112. You want to leave about the same amount in cash due to span margin requirements. So typically I use around $11,000 to $12,000 total for each individual 112 I do. And then when you close out the naked puts, you get pretty much all that buying power back because there's no more risk on the table. When you actually enter the 112, you already used up the full amount of that buying power by taking off those naked puts. Still the short put of the put debit spread was factored into this. So you get your buying power back, and then it's almost like a revolving door. You go in one side, you go out the other. So as we enter in one trade, we're usually taking off another trade, and then you enter the trade, take off, and it's just like a rotating wheel at that point. One of the things that I'm noticing quite a few people talk about the 112 is they'll enter in a trade, and then the market drops very quickly, or if the volatility increases very fast, and then they show all the down negatives of that strategy. Now, obviously, if those conditions happen, yes, you will be down on that particular 112 trade. But if we were layering them on and say every 2 weeks or every month, we're adding on another one, the ones in the back end were already closed out those naked puts. We already have that hedge in place. And then those put debit spreads, if I do a 50 with put debit spread on ES has a 50 multiplier. That's 50 times 50 or $2,500 in possible profit there off about a $11,000 trade, which is a really good amount. So you want to consider as you're closing out the naked puts on the ones from a few months ago, that is helping cushion the blow if we do get that downturn. And sure, you might eventually stop out or take a pretty significant loss on one initial 112. But if you're doing these in a rotating basis like that in a campaign, it should more than offset it. Now, I do additional hedges beyond that as well. I'm not going to just do all 112s. I've been looking more into the bigger widths. I'm actually doing a 300 width 112 at this point for some of my trades. I don't do those as every 2 weeks or whatnot, but having a 300 width, you're not going to get as much credit in the whole trade because obviously the bigger width's going to cost more, but it's more of that hedging factor of having a huge width in case, the market does drop.
Yeah, exactly. You could modify the width of the debit spread in order to hedge more. And remember that Lance uses ES. So a comparable trade that you would make, let's say you were going to hedge and implement this position on SPY. If SPY is trading right now at around like 550, you can then buy the 520. Let's say you wanted to go around 90 days out or 120 days out. So let's say like 90 days out, you would buy the 520, then you can sell the 515. And then obviously, because that is a put debit spread, you would be spending money on the hedge. And then in order to finance that position, you can then sell 2x of, let's say, the 500 SPY positions at the same expiration, and then finagle that and choose specific strikes so that you would receive a credit. Mm-hmm. Then what you would do, and as Lance was discussing earlier, if the market continues to go up significantly, you can then close out. You can put like a good to cancel or a GTD, which is a good till date, because that allows you to extend the order for greater than 60 days. So then you can actually, I think it's up to around 2 years actually. So you can choose the GTD for like 3 months or 4 months, and then you can close out the 520 by 515 debit spread for like a smaller amount that would then still enable you to leave that short 500 put contracts on for a riskless position, or rather, sorry, the 500.
Yeah. You want to close out the 500s and leave the put debit spread
on. Close out the 500.
Yeah.
Right. You close out the 500 and then you'd buy that back, and then that would enable you rather to leave on the 520 by 515 hedge for essentially a riskless hedge.
Exactly. Another way to go about it, a little bit more advanced, is if you have that 5 width on the SPY for the put debit spread, let's say the market drops a little bit, not quite at the 500 strike, but say we're in between the 500 naked puts and the I think you said 520 on the put debit spread. What you could do is roll up the short put of the put debit spread. So if you're starting with a 5 width on SPY, it's going to cause a certain amount of debit. But if the market drops, the put debit spread will be worth more because you're closer to the sold put. What you could do is roll up the sold put of the put debit spread to get a credit for it, because as you're getting closer to in the money, in that case, it's going to be more valuable than it was. And what I do a lot of the times is if I could roll up halfway. So if you have a 5 width, you could roll up, say 2. So instead of 525, 520, you could roll the 520 to say a 522 or so. And then in that case, you would have a 3 width spread instead of the original 5 width. But sometimes you could actually pay for that initial debit spread that you did when you first started the trade. So that's an even more conservative way that you could go. You wouldn't make as much max profit, obviously, if you have a 3 width compared to the original 5 width, but you're making it a safer trade because then at that point, the put debit spread was completely paid for from that rolling up. And that's another thing that I'm actually looking into for the 300 width on the 112s. By having a 300 width, you're not going to necessarily need that the whole time. I mean, obviously, if it does drop below it, that's a huge gain. But by rolling up that short put, of the put debit spread. I'll typically roll it from 300 with on ES to 150 with. And then I'll look into rolling again to the original 50 with, which is what I'm doing with most of my trades. All of those will be taking in a credit as you're in the trade. And what I like about that one is in the beginning of the 112, you do have the most amount of risk on a big downturn or big VIX spike up. But as you're in the trade longer, the theta decay on those naked puts initially was going a lot quicker than your put debit spread. But when you're later in the trade, you actually want the market to be dropping a bit because that put debit spread could actually make more money. And then at that case, you don't necessarily need the really large put debit spread. And it could be more advantageous to roll up to make it a smaller debit spread at that point, but also taking in credit as you do that.
Right, because the deltas on the spread are significantly higher than the delta on the short puts. So therefore, as you get closer to expiration, then you don't necessarily mind if there's like a 5% pullback, because that could actually be profitable for you. There's another way of utilizing this strategy where if you wanted to have, if you had more of a bullish stance on, let's say, and I made this trade on NVIDIA, you can structure the trade where you're buying a call spread. Like let's say, post the when NVIDIA split, let's say you would buy like a 130, sell a 135, and then you can either finance it. You can be creative with the financing. You can either finance it by selling like a 150 call, or if you wanted to actually take ownership of NVIDIA, let's say you felt that NVIDIA was overvalued and it would be, and actually it did almost fall close to 20%. I think at one time it fell all the way down to around 117 just this past week. We're in like the last week of June 2024, when it hit slightly above 117. And just 2 days prior to that, it was trading around 140 and 70 cents, like something like that. So it almost corrected close to 20% in around 2 or 3 days. So let's say in that situation where you were going to buy the 130 call, you would then sell the 135, and then you can either finance it by selling the 150, or you can also, that would be a call option that you would sell the 150. And then if you wanted to, you can sell like the 105 or the 100 put option. And in that case, you would just sell a strike price on the put side where you wouldn't actually mind taking ownership of the stock. And in that situation, you can then get assigned and then run the wheel if that's something that you like to do, therefore reducing your basis. So this type of structure is extremely flexible, and it's something that I've really implemented based upon a lot of my conversations with Lance. It's really helped my trading to capture more directional moves, and it can also act as a hedge. And I think that it's a really great strategy.
Yeah, definitely agree with all that. You can take ownership by doing your credit spreads on the call side. You can do the put debit spreads. Also, for different futures instruments like gold, oil, other commodities, they sometimes have more call skew than the put skew, especially with gold right now. You could sell like a 112 on the gold for the call side. So you would buy a call debit spread above the current price and then sell one or two naked calls against it. Sure, you have a naked call there. It gets a little scary at times, but you do have that call debit spread. But if you're looking at the individual deltas on the call side compared to the put side for gold, for example, you take in a lot more premium on the call side for gold right now. ES is more put side. Obviously, the market is very long-term bullish. So because of that, there's a little bit more risk on the put side. But if you look at, say, gold and sometimes oil, you can have more on the call side instead of the put side. So it's very interesting about individual commodities, especially. Most stocks would be probably more put side because in general, stocks go up in the very long term. But definitely want to consider that when you're looking at it.
And also the velocity of risk is to the downside. So even though there's a tendency for stocks to go up, when there's a panic, then even like 2022, Amazon, Apple, Nvidia, some of these stocks got cut in half by 50%. So that's part of the reason why for individual stocks there has a tendency to be more available premium, like on the put side, especially on like a short-term basis.
Right. I think piggybacking with that, I'd like to talk a little bit about the psychology of when you're in a trade. And this could apply to 112s. It could apply to pretty much any type of trade that you're doing. Is I see a lot of members that are very happy when they see a short-term gain, and they might close it out earlier than their trading plan, if they even have one, or what they normally was going to try to get for their target profit. And then on the flip side, if you see a trade that's going against you, I see a lot of members that might just be taking it out much earlier than they initially were thinking of. Well, have you seen that with some of your members, or what are your thoughts on this?
I think that because we deal with high probability trading, one
Yeah,
of the biggest things that we need to protect ourselves against is making sure that we don't necessarily get caught up in the win rate. And I understand
yeah,
that I'm a little bit of a hypocrite when it comes to that, because on my website it's like, oh, win up to 98% of your trades. But
yeah,
the reality is that attention is very important. So I have to have something that captures people's attention, but then there has to be a lot more nuance and a lot more substance behind it. And when you engage in like high probability trading, I think that if you feel uncomfortable, okay, so let's say you sell a put, and for you it's actually easier because you're primarily trading in ES. But from my side, if I'm dealing with stocks, you have to ask yourself, are you comfortable getting assigned? And yes, you can roll the position a little bit. You can sell some call options, then allocate that premium and then roll down the put option. But if you're not comfortable with the position and you don't want to get assigned at that specific strike price, then I genuinely believe that the best thing to do is to close out the position, even if it's for a loss, and make that money back on another trade. And yeah, I think that's really the biggest thing. On the opposite end of the extreme, there was a situation recently, just this past week, where some people, they traded Toyota, and I traded like a 190 put option on Toyota, but I also put out to my alerts members that if you're going to trade a spread, then you can trade the 195, you can sell the 195, and then you can buy like the 180 or the 185. The issue was that last Friday, I think Toyota traded to around like 193, and like the high 193s. It closed last Friday. But then this past Monday, last Monday or Monday and Tuesday of this week, I think it traded all the way up to around 205 and 206. And then today it was down like a few dollars.
Mhm.
But I had a few people email me and say, hey, what should I do? I'm going to get assigned this position. And my response to them was very simple. Do you feel comfortable owning Toyota at 195? And especially considering that its 52-week high, I believe, is over $250. Toyota is a large cap company. It has an amazing brand, and stocks with great brands have a tendency to outperform even the S&P 500 because the brands are valuable. So it's really not rocket science. You ask yourself, do you feel comfortable taking ownership of this stock at the strike price? If the answer is yes, then take ownership. You can run the wheel, and then hold on to it for as long as you feel comfortable. Hopefully, you'll hold on to it longer, because when you're long stock, it's usually worthwhile to just, the money is made in the waiting, not from the actual like trading back and forth when you're long stock. So
yeah.
basically, if you don't feel comfortable and a trade is challenged, close it out. If you feel comfortable, it's okay to take ownership of the position and then participate in the upside.
Yep. Have you ever done any covered strangles off individual stocks?
I haven't.
Okay.
The strangles that I usually do are for the one DTE strategy. I trade I trade one DTE on the SPX. So then
Mhm.
I trade strangles on that. But usually, if I'm going to take ownership of the stocks, then I will run the wheel. But occasionally I will run a strangle, because let's say I want to reduce my basis and I feel like
Yeah.
the stock is going up, then I will sell some additional put options on it. So yeah, but I will do that. But because the capital requirements are different between
Yeah,
options and stocks, I don't necessarily want to be in a position where if the market continues going down, then I don't want to be assigned even more shares.
sure.
So I'm a little bit hesitant to sell additional puts if I'm already long shares.
Fair enough. That is something that I have been doing with MES contracts. I
Mhm.
wouldn't do it with ES just because if it does
The
have a huge
sizing.
drop down, the sizing could really add up. But what I do sometimes for MES is I will sell usually two naked puts. I'll sell one near the expected move. It's a little bit higher delta than I normally do, around 0.16 or so. And then I'll sell a second put around 0.08 to zero point 0.1 delta. So I'm taking in premium from both of those. If I happen to get a sign on the higher delta one, at that point, the other one would have expired worthless. I'm going to take assignment on one MES contract, and then I would do a normal covered strangle with it, where I would sell a call against that contract and then sell another put against it. And with this really good bull market, I've almost never gotten assigned on an MES. I think I've only been assigned twice in the last year and a half, which is pretty amazing to be honest. But and eventually we are going to get assigned on these. But if I'm perfectly okay with getting two MES contracts, if it happened to drop that low, and
Right,
then
exactly.
being able to lower that cost basis by selling those puts, selling the calls against the contracts as well. I think that so just to me, I'd prefer doing a covered strangle over the wheel, especially if you have the buying power for it and you're able to take, 200 shares of stock possibly, or two contracts of a different futures account.
So let's say you on your original position you were assigned some shares. What are you going to lower your delta for the new puts that you would sell, or you would still be relatively aggressive in
Good question.
selling?
Yeah, good question. It pretty much depends on the chart, I think, at that point. So if I could sell another put that's below like a recent support level, or if I'm seeing that the EMI is getting, 21-day moving average for exponential is getting to a certain price, I might try to sell the second put a little below that, just in case if it happens to drop below that, then at least I'm getting a much better entry point. That's more of the kind of art than a science
Right, right.
kind of
Because it
case
also
there.
depends on the premium that's
Right.
available, and yeah.
Yeah, you got to factor in, are you okay with getting a certain amount of premium by possibly getting a higher price in the stock compared to getting a lower amount of premium, but a lower entry point? So I usually lean a little bit more on the conservative side in those cases where, especially if it's below another recent support level, I'll probably sell a little below it in general. And then what's interesting about that is in the call side, you could go the other way too, and that's very flexible. You could sell an out of the money call against an assigned 100 shares or futures contract, and then you could, if you sell out of the money, you could get some actual capital gains on a position, plus the premium you're taking in. If you sell it at the money where you had assigned, it's kind of the best of both worlds in a way, where you get a decent amount of premium, and then you wouldn't necessarily get any capital gains. You could also sell an in the money call against the 100 shares. You'll get even more premium than the at the money. Obviously, you'll lose a little bit in the capital gains, but it actually does lower your break even a bit, especially if the market drops even more. So it's very flexible.
Yeah, I've been experimenting a little bit with, instead of buying a call debit spread to sell an in the money put, put credit spread.
Yeah.
And it's interesting. I'd work out the math. The issue with selling the in the money put credit spread is that it carries assignment risk,
All
but
right.
in general, you're usually able to collect slightly more premium from doing that. But or like when you work out like all the math, like with the max loss, et cetera,
Right.
versus what you paid for the call credit spread. But it's usually slightly more advantageous to sell the in the money put credit spread. But I guess it's on a case by case basis.
Yeah, of course. Could be skew as well, or amount of volume in the contracts. And sometimes you'll
Right.
have a lot more volume on the put side than the call side as well. All right. We've been branching off into a lot of different things. Anything else you'd like to talk about at this point?
Let's see where we think the market's going. Um, I guess Well, did you mention that Tasty Trade? Because you use Tasty Trade, right? Did
Right.
they change their cost structure to make it more advantageous for trading futures?
In terms of commissions, you mean?
Yeah.
Yeah, the commissions are the same since I've seen it the last few years. The buying power and margin requirements have pretty much stayed the same since I've been doing these a few years ago. But Thinkorswim, they just got acquired by Schwab, and their margin requirements on that 112 or any of the futures trades has significantly increased compared to what it was before. And they were actually increasing it before the merger, but then literally the day or two after the final merger, I still have a Thinkorswim account for stock trades. And then I was looking, the margin requirements went up quite a bit from there, which I guess Schwab is just trying to be more of their bigger company. They have to talk to their shareholders and whatnot. But quite a few members are pretty upset about Thinkorswim with their margin requirements.
Interesting. I know that there are some times during like a market crash when individual brokerages will actually increase their margin requirements
Right.
for fear. So I wonder, it's probably not like any sign that they believe that the market's going to pull back. It's probably more so like the overall like oversight from like Schwab, which has been around for like 150 years or so. And
Right.
I guess the last question would be when you test the new strategy, like can you walk us through like some of the steps that you take to, when testing and to make a decision on whether this is something that you want to implement into your day-to-day arsenal or rather into your day-to-day toolkit?
Sure. And I'm actually testing out a broken wing butterfly strategy right now. I'll just quickly go over some of the basics on that one. In a broken wing butterfly, you're going to be selling two puts, typically pretty low delta, and then you're going to buy a put a little bit above it and buy a put a little bit below it. But the bought put is going to be much further away than where the buyer put is. So it's essentially a put debit spread and a put credit spread combined together. But the put credit spread part is going to be a wider width than the put debit spread. And then you'll be taking in more premium on the put credit spread because of that bigger width. And you'll start the trade at a net credit. So for the broken wing butterfly strategy, I'm looking at a 21 DTE, where if the market is above the 21 EMA, exponential moving average, then I'm going to look to sell around the expected move. And I'm also willing to go a little bit above that on the two sold puts. So I would typically try to sell two puts around a 0.2 delta or so. And then for XPX, depending on your account size, I'll typically go around 15 or 20 points above it, and then double that below it. So I'm going to have the width on the put credit spread side, double the put debit spread. And I'm not going to try to get greedy here, where if you look at the broken wing butterfly, if you end up closing right where your sold puts are, that's where the max profit is, because the sold puts would expire worthless. And then the bought put from the debit spread side would be at a good amount of value. At that point, you're going to make a good amount of money. It could be up to 10 times more than the initial credit you took. But I'm not trying to get greedy on this one. And I'm looking at different back testing. So a little bit more of what your actual question was is I'm first going to look at back tests on different, where to take profits, when to take profits and whatnot, how many days you're going to be in the trade. Option Omega is a good resource for that. I'm not sure if you ever used it before. But doing that, looking like a 10% profit based on the maximum amount of risk. So in a broken wing butterfly, it could be, with the numbers I said before, it could be around $2,000 in margin requirements for it. So I'm going to look to make $200 in the trade. So that'll be 10% of the max risk. And by doing that, I first studied the trade, I back tested it first. I looked for different technical indicators or reasons why I want to take a trade at a certain time. I'm not going to be always taking this trade, for instance. Like if the market's in a very big bear market, I'm not going to take the trade at that point. And then you actually just got to take the trade knowing well beforehand what your take profit numbers are. I think that's a key point. So what a lot of people will do is they'll take a trade and then they'll just see how it goes. Like, oh, maybe it's at a good profit. I'm just going to close it now. I think one of the keys is to have a written trading plan where you know exactly what you're going to do before you start the trade. Actually take the trade and do this with a decent amount of occurrences. Like ideally, you could do this like hundreds of times before you figure out it's a viable strategy based on what your goals are. But I'm willing to do this on a smaller scale, just doing one contract at this point, and also be perfectly okay if it hits your stop loss where you're willing to lose a certain amount of money that you, again, knew before you wrote your trading plan out. And then just implement it and not have any fear about what happens. So I pretty much summarized Trading in the Zone by Mark Douglas. I'm not sure if you ever read that book before, but no, it's a great book. Definitely recommend reading that one. But having that just psychology in mind, knowing exactly what you're going to do beforehand, having no fear in actually taking the trade. You know, life is hard at times. There could be a lot of different things that happen with your life, and there's really not much you could do about it in the end. Then trading could be the same way. If you happen to have a stop loss, you don't really worry about it. Just take the next trade and then just get enough data points. Be willing to lose in a stop loss in a certain amount of trades you're willing to do. So if I happen to stop out on every single trade that I'm doing, which would be extremely unlikely, just based on probabilities, then I'm still okay with that. And then I realize it may not be a viable strategy for me. But otherwise, just go into it knowing the possible worst case scenario based on what you have in your plan, and then just implement it and see if it's worth it for you or not.
And then what trading environments would this broken wing butterfly perform best in? I know that you mentioned that you aren't going to put it on in like a market crash, so it seems like it's more of like a bullish strategy,
Yeah.
correct?
It still is a bullish strategy. Your max profit is in a slight downturn because, again, you have those two sold puts. And if you get right to where those sold puts are, those expired worthless, and your bought put that's higher up would actually gain a lot of profit. However, based on my strategy, I want to make 10% of the risk available. You actually want a neutral to bullish side there because if the market stays where it is or goes up, your put credit spread part that's actually taking a more premium than the put debit spread would decay faster. And then you could get more of that put credit spread side of the trade compared to the put debit. It's almost like you're taking in, say, $300 on a put credit spread. You're paying about $150 on the put debit spread. So as the market goes further out in time, the put credit spread could actually decay faster. So
Right.
ideally, we would have a neutral to slightly bullish market. I actually started one of these I think it was last Thursday. And since then, the market dropped just a little bit.
Yeah, I
So,
think it was down like 3 days, it was down
yeah,
like 3 days in a row or something, and then
right.
yeah.
It was down 3 days in a row, but nothing dramatically down. I
Right.
think the most was like 0.5% or so. And the last 2 days were pretty much neutral. So because of that, it's pretty much a break even right now. In a 21-day trade, based on the back test, it should hit the 10% of the max risk in about 12 to 14 days. So you do have to stay in the trade a little bit longer than you normally would if you just sold the put credit spread by itself, because you have the put debit spread as well. But because of that if the market does drop a bit, but not dramatically, the put debit spread could help cushion the blow a bit because that would be gaining more value as well.
And when you're putting this trade on, are you putting it on for a small positive delta?
I have to double check. I think it is a small one. It's not dramatic because it's only 21 days out and the
Right.
risks are relatively close. Yeah, and like a normal butterfly would pretty much be delta neutral, especially if you did it at the money. But if you're going out on the money, it should be a positive delta on that point.
The only issue that I've had with butterflies from my experience is that, especially when you get to further DTE, they oftentimes require a lot of adjustments,
Yeah.
and but especially with delta neutral trades. But overall, I mean, I'm very curious to see how this strategy is going to work out.
Yeah, based on the back test, it does have a pretty high win rate. And if you're willing to take the stop loss, my stop loss will be if it hits the break even point from what Thinkorswim tells us it is when you enter the trade. So if it ever touches that break even point, the break even point that Thinkorswim would show us would be at the expiration date. But if we touch the break even before that, you will be at a loss. However, it won't necessarily be a dramatic loss, especially if it happens much closer to when the expiration date is. So yeah, the trade will work well in neutral, bullish up to any side, slightly bearish markets. It'll just take a little longer to hit your profit, but it will be pretty. You'll hit your stop loss or be affected in a pretty big downturn.
Do you think you'll be anxious at all when you're on the cruise and you're not logging into your account or looking at the market? Because for
Right.
us, I'm sure it's become like a little bit of a habit. Like the first thing I do, like at 9:30 a.m.
Wake
Eastern
up.
is I check the first thing I do when I wake up, or one of the first things I check the futures market. I check the futures market before I go to bed. I'm just curious. I love this stuff. And I'm curious to how do you think you're going to be like, do you think you'll experience any anxiety to break up that habit or no?
I'm not sure yet. I'm not going to be doing certain trades. I'm not going to have them on during it, obviously. Most of my trades will be longer dated, the 120-day 112, where I'm not going to be too affected by it. And I'm going to be putting on a hedge that I'm just going to buy probably a 30-day ES put or put debit spread. And then later, see if the market happens. Hopefully, no black swan flapped its wings. And then I'll just close the hedge out at that point and don't mind whatever the loss on the hedge is. So I think it's going to be okay. Again, I'm also in much lower amount of my buying power used. So, if I was using 60, 70% of my buying power and then I went on vacation, probably Tasty Trade would close out positions on a black swan at that point. But if I'm at 30% and I have a hedge on, most likely it'll be good. And fingers crossed the VIX stays pretty close to where it is for about a week.
Yeah. Are you cruising out of Galveston?
We're going to LA and then we're going to go down to Cabo. It's a
Okay.
new Carnival cruise ship. It's like an Italian themed one. So never been on a cruise before. It should be interesting. I could definitely afford the internet on it, but the cost of internet on the cruise is just ridiculous. So
Yeah, it is. Yeah.
yeah, we'll be fine. Just
Yeah. I went on a cruise like a few months ago on Royal Caribbean, and it was good. I did pay for the internet. One of the reasons is that for my kids are like addicted to like their tablets, so it's almost like babysitting. But yeah, it's definitely worthwhile. Like yeah, I love it. It's a great value, especially if you don't drink, because or especially if you don't drink or you don't gamble, then it's a great value and it's a great way to see like, many different ports and things of that nature. So I'm curious to see, what your experience will be as well.
Yeah, sounds good. I'll let you know how it goes. All right.
Cool.
So, yeah, David, it was a great talk that we had here. And definitely appreciate you spending your time talking about these different strategies, psychology, and how we could actually help out with other members.
Always a pleasure, Lance. Thank you so much. And thank you guys so much for watching. And we'll do this again in a few months as well.
Sounds good. On the description on both of our YouTube channels, you'll have access to each other's information in our YouTube page. So feel free to send us a message, leave a comment in either of our videos, and we'll both respond to them to make sure we could answer any questions and address it the way that we need to.
Yep.
Okay. Have a good evening, David, and have a good evening, everyone else that's watching this video.